Okay, everybody, are you ready to go? Okay, we're here for the Finance Committee this afternoon, and our agenda is a little bit differently written, so hopefully I'll be able to follow it in the order it is written. I think we all want to say thank you to Deborah Ocker for all of her wonderful work in running this committee and this department. We didn't know she wasn't coming today. I brought her some flowers. But let's say thank you and appreciate all of her work. And sorry we won't see her here, but maybe we'll see her at another event. So with that, we miss you, Deborah, but we'll go ahead and get started. Can we go ahead and call the roll call and also discuss how the meeting will be run?
Yes, happy to do that. This is Shannon Rice, Recording Secretary, taking roll. Chair Corbett.
Here.
Director Mercurio.
Here.
Director Rosario.
Here.
Assistant Finance Officer Deborah Spalding.
Here.
Thank you. This meeting is being held pursuant to the Brown Act. We are providing live video and audio streaming. Members of the public wishing to make a public comment can do so one of the following ways: live in person or via the Zoom meeting, by submitting an email, or by leaving a voicemail. This information is noted on the agenda located at the Park District's website, ebparks.org. If there are no questions about the meeting procedures, we can begin.
Okay. Just going to put my mask on and go ahead and get started. The first thing we'll be doing is approving July 26, 2023 Finance Committee meeting minutes. You all have those with your packets. If you want to take a quick look at them and let me know whether you're okay with the minutes as they are.
Yeah, I'll move approval.
Okay, we have a motion to approve.
Second.
In a second.
Recording Secretary Shannon Rice, taking roll call vote. Chair Corbett.
Aye.
Member Rosario.
Aye.
Member Mercurio.
Aye.
Thank you.
If you speak of the meeting and how it moves forward, like we used to do.
I did the Brown Act information. I think that was it.
Okay. Then I'll just go to the next item. Take a look at approving the Finance Committee meeting.
We did that.
We just
Mhm.
Then
Public
next
comments?
item is any public comments on items that aren't on the agenda. Okay. So the items we have before us are the information items. The first item is A, informational report regarding 2023-2024 tax levy for general obligation bonds, debt service, and assessment valuation. Thank you very much for the presentation.
All right. Good morning, everyone. Can you hear me okay? Microphone all right? I'm Deborah Spalding, Assistant Finance Officer. And this first item is an informational item. It comes to you every year. And it's giving you an update on the tax levy that's going to be levied through the two counties for our Measure WW bonds. So you may recall back in July, on July 18th, the board passed a resolution saying that we are authorized to calculate this tax levy and then give it to the two counties. And then we said we would come back to the Finance Committee with that actual percentage rate. And so here it is. This year, the levy is going to be, it's 0.0057%, which translates to $5.70 per 100,000 of assessed valuation. And in comparison, last year's rate was just a tiny bit higher, $5.80 per 100,000 of assessed valuation. Back in the 1980s, when we passed our Measure AA bond, we told voters we would do everything in our power to keep that tax levy rate at below $10 per 100,000 of AV. And so that is our goal. And we have been able to do that this year. And then just to translate that to how that looks to somebody who's in like an average house, although this, I think this is showing a little bit above what an average house would be. So this is based on what the average sale price of a house in Alameda County was in July. So 1.1 million is the average sale price. And so at that cost, the tax levy would be $62.70. In Contra Costa County, that average sale price is a little bit lower. And so $46.17 is how that would translate on their tax bills. And that is all the slides I have. It's an informational item, so I'll be happy to take any questions.
Yes, please, please go ahead.
Can you explain what the secured AV is and how that works or how that's calculated?
So how it's calculated. So the two counties have an office that goes out and calculates what the secured value is on property in their county. So there's one for Alameda County, one for Contra Costa County, and they take into account like what's been constructed in the past year, if people have done additions onto their homes. And then there's a 2% increase that is automatically applied unless we're in some kind of deflationary environment. And that all goes into the secured value for the whole county. And then we apply our tax rate onto that.
Right.
Okay, you're welcome.
All right, thank you. Any other questions, please? Go ahead.
Yes. First of all, what a deal, huh? I mean, looking at my county for Contra Costa Force, 4670. That's great. So I'm wondering, I think kind of going off on that, do you recall or do you have any data there accessible that as to whether it's ever been significantly more than that in the last, say, 5 to 10 years?
So we have in the packet.
Oh,
I don't know if you
no,
can-
it's in the packet.
It goes back to what it was.
Sorry.
You guys get a lot of reading material, I know, but it goes back to like the last 5 years. And so it was as low as $2 a couple years ago. And then when we sold our bonds last year, we have this new tranche of bonds, it's called, that we have to pay off. And so it went up to 570. It did actually, if you go back far enough back into the Great Recession, we did actually cross that $10 threshold. It was like $10.10 because suddenly assessed values really bottomed out and we had just sold new bonds. And so the timing was just terrible. But so that did happen once, but we do not intend for that to happen again.
That's kind of what I was thinking of because I was on the PAC during that time and I remember the discussions and I was just kind of wondering how that's one way of measuring how bad is it, and
Yep.
that's how bad it was to be
Yes.
that much more than what we're asking for now. So,
Yeah,
okay, thank you.
you're welcome.
All right. I don't have any questions and we don't, thank you very much for that presentation. And this is an item that doesn't have action required, or vote. So we'll move on to the next item. The job order contractor program quarterly report. Hello.
Good afternoon, Finance Committee members. I'm Ren Bates, Chief of Design and Construction. I'm here to provide a quarterly update on our job order contracting. I'll have a few slides to share.
Thank you.
Bear with me for one sec. Here we go. So this is a quarterly report. This is about job order contracting. As a reminder, job order contracting is a fixed cost, indeterminate quantity, and finite time, an annual contract. In January of this year, the board approved authorization to enter into 8 job order contracting contracts. This is broken down into 3A contracts, 3B contracts, A being general engineering, utilities, B is building, and the last is paving. We have 2 paving contracts. Each has a maximum contract value of $2 million. This is less than what the state authority for job order contracting allows, but this is where the district has landed, and we're required to offer a minimum value of 50 to each of the contractors. It's competitively bid, just as a reminder. So that's where we are. Here's the list of our projects at this point where we are. So they are annual. The board authorized in January. It takes us a little while to get under agreement and under contract. And so the year for the contractors begins when we issue our first NTP. And so even though we got authorization in January, most of these don't, like, for instance, the 7 that are here, their contract or their annual contract starts when we issue the NTP for these projects. So that most of them theoretically have begun in like May through June or July of this year. And so their contract would go through May or June and July of next year, just to clarify that. So in terms of that, these are the projects that we have gotten a notice to proceed on, or given a notice to proceed on. Again, as a reminder, part of the project cost is there's a first review by the contractor based on the construction task catalog. And those are based on the scope of work that the district has provided. Our consultant, the Gordian Group, will take a first stab at reviewing that. And then the project manager at the district will be responsible for a further review. And that's checking quantities and scope and making sure that the price fits in with our scope. So that these approved costs have been vetted and reviewed by the project manager at the district level. And then it's for final approval. It goes all the way up through our finance folks to make sure that there's project funds in the project to account for the cost. The 15 below are projects we're currently reviewing and have either gone to have a pre-price proposal and or in the process of going back and forth with the contractor based on the review of scope. Here's a couple of photos of projects that are going. This is the Hayward Marsh Cogswell Marsh Bridge repair. This has gone, we've actually utilized the last 3 or 4 rounds of contracts to do this work. The reason that job order contracting is great for this work is that it allows us to have rates for off hours. As this being work in tidal environment, we want to work when there's no water. And so you can see one of these is nighttime work, and that's one of the items that they bid. So it's a good way for us to do this work without having, in terms of providing some flexibility with some fixed costs on that. This is the last year, actually, we're going to do the Cogswell Marsh Bridge repair. We've got them complete. So this is the last round where we'll be jacketing these piers. It's just a great thing. So another one we're working on is at the Burrell property. There was an underground storage tank. That's what UST stands for. And so we're utilizing one of the contractors to take that out. We'll remove that. We'll probably have to off-haul a little bit of soil from leakage from the tank, but it's just one of the other projects we're working on. Sure. How much was it to remove? Oh, I don't remember. I'll have to get back to you on that. It was, I can't recall. It was like a 50-gallon, or it's not insignificant. So I'll get back to you on the exact size of that.
I was just trying to, I'm thinking about Point Malade. Huge.
So I can find out more. Those are all the photos I have of the projects we have going. I'll bring more next time. This is informational. I'm here happy to answer any questions, but that at this point concludes my update.
Okay, thank you so very much.
Sure.
Additional questions, please go ahead.
In the ones in construction number 5, Miller Knox, that is under $50,000. So typically we
Sure.
those in-house.
Yeah, but so that one is specialized. That's putting a screen on the intake for the lagoon. It's specialized work where they're going to have to be sort of in water. It was determined that would be better suited to a contractor in terms of the work that's provided, because it's not a typical task for staff.
Okay, great, thank you. Just an aside. Something I learned at the CSDA conference, and I just refreshed my memory from way back, is that special districts, government, public agencies are required to do a minimum to go out to bid after $50,000.
That's
And
correct.
if you have a special, like I think Oakland School's got a special waiver to go to 109,000. But so just wanted to point that out too.
Yeah, in Director Rosario, school districts are under a different section of the
Yeah.
Public Contracts Code. They have their own minimums, but you're right. For special districts, we're under that $50,000 requirement.
I remember that from my union days. Thank you. But I thought I'd just bring that up.
Thank you.
Thank you.
Well, thank you very much for that presentation with those 7 items for coming up here. It looks like you'll be very busy with some very important projects. So thank you for that work. Appreciate it. All right. This was also another item just with information. And then the next item is the. Oh, yes. Please come forward.
Good afternoon. My name is Meadow Darcy and I'm from ASME Local 2428. I just wanted to follow up on the minutes from the last meeting about this item. It talked about, I think Director Rosario had asked about a second roads and trails crew and the on-call firefighter account. I just wondered if there was any update on that and also if there was any update on the paving report, because I see that there still is paving going on, and from my understanding, it's been in draft form for about 3 years. So I'm hoping we could get a final copy. That would be great. But if I could get an update on that, that'd be great. Thanks.
I talked with the general manager, and she still has some questions to regarding that report. So she has to go over that with Robert Kennedy. And then as far as advocation for the second roads and trails crew, that's in our if you saw the board material for priorities, that's on our list. So just want to thank you.
A lot of support for this that during that discussion. So thank you. And then the other item, the second item, did you have? Okay. All right. Those have been addressed. Okay. Thank you very much. Okay. So our next item, if there are no other speakers on these, is item 7, informational report regarding Beacon Economics assessed valuation forecast. Go ahead whenever you're ready.
All right, good afternoon. Deborah Spalding, Assistant Finance Officer. And hang on, just trying to share my screen here. Go. Sharing for a second.
The desktop already.
Okay.
Oh, no.
First, you won't be the last.
Thanks.
Shannon saved the day. All right, thanks for your patience here. All right, move down. Okay. And there we go. Okay. All right. Deborah Spalding, Assistant Finance Officer. This next item is another annual information item that we bring you. The Park District contracts with Beacon Economics, and they are a California-based firm that does economic projections for different agencies throughout California, and I think nationally as well. We use them to do a 5-year projection of our assessed value and property tax revenues. We started working with Beacon back in 2009 after Measure WW was passed, and kind of getting to what Director Mercurio was just asking about. We had just passed these bonds, and we're trying to figure out how we were going to structure the debt payments so that we could stay within that $10 of 100,000 assessed value. And so worked with Beacon, and as you can see, this is a screenshot of their first projection, and you could see they were saying, hey, your assessed value is going to be dropping for the next 4 years. And so we needed to structure our debt service payments differently in order to respond to that. So this was a dire situation, but they provided a lot of value. So we've continued to work with them in the ever since then. So jumping into the report that was in your packet. So they give us some information at the high level, the entire United States level, and they go a little deeper looking at California, and then they spend the bulk of the report talking about what's going on in the East Bay. And so these are highlights, although they're not actually that rosy, so they're sort of more like not quite low lights, but anyhow. So at the federal level, the Fed is saying that they plan to pause interest rate increases, but Beacon believes, and they say most economists believe, that in fact further interest rate increases are going to be necessary. So that does impact assessed values, because that means that it's harder for someone to get a mortgage at a rate that's doable for someone. So that's why that's important at that federal level. And then they look deeper into the California information. And this is something that I thought was interesting, that showing that California's population actually has been decreasing over the last couple of years. And so that was a revision of a previous projection. And then looking more locally at the East Bay, again, just a couple bullet points that I thought were interesting. So on a monthly basis, home prices are declining in the two counties. So it's declining more quickly in Alameda County than it is in Contra Costa County, but both of them are declining. They're still doing, the rates have come down from where they were like right post-pandemic, but they have not dropped down to being below like the average trend over the long term. So it's a decline, and you'll see this better on some charts that are coming up, but it's not like a complete drop off. And the reason for that is this next bullet. So there's a really constrained number of properties on the market. So because of higher mortgage rates, people aren't wanting to sell and move because they're not able to find some place where they can get a new house at a good cost. So people are holding on to their houses. And so new home buyers aren't able to find homes. And so the homes that are on the market are selling for like higher than they would otherwise. So that's why home values aren't coming down as quickly as they otherwise might. And so here is the forecast for 2023 compared to the forecast for 2022. So the blue line is the most recent projection, and the red line is the projection they gave us last year. And you can see they're hitting that same level in 2024-25, which is the one that we really care about, what's going to happen in the next year, of around a 3%. But in fact, their projection for 2020, if you look at the red line, what they had projected to happen in 2023 was like a little bit lower than what actually happened. And that does tend to be the case. So they tend to be like a little bit conservative on their projections, but still good data to have. And so looking at their blue line, they're kind of like saying lower for longer. If you look compared to the prior year projection, they were previously projecting that those assessed values would bump back up a little more quickly. And now they're saying, yeah, it's going to stay around the 3% for another couple of years. And then it's going to slowly get back to around a 4 to 5% rate. And so a couple more slides. So Beacon Economics gives us three forecasts: a low, a baseline, which is the one that we always use for our budget, and then a high projection. So getting to the meat and potatoes here. So what we know from the two counties already what the assessed value increase will be for 23-24. So that gives us half of the 2024 year. And then we use Beacon's projections for the second half of 2024. We combine those, and we are currently projecting property taxes to increase around 5.1%. So that's what we're going to be building into our budget models for next year. And then here's just a slide showing you what their low baseline and high projections were. And so, worst case scenario, we would have like a 0.3% AV increase, which would be a challenge for us for sure. The baseline, which is the one we're going to use, is a 3% average across the two counties. And then if things went really well, we could see as high as 5.7%. That is their projection. And
Is there anything in particular we should be worried about?
I think nothing to be worried about. It's I think it's helpful going back to the I can go back here, looking at that blue line. And if we were to stay, so the 3% assessed value increase is kind of on the edge of what we can, because we have natural increases in our costs, right? So inflation, staff cost increases. So having a 3% AV growth for several years would be very challenging for the district to manage. Like we would have to, we wouldn't be in the same situation we've been in the past where we're consistently adding new staffing and new projects. So it would really constrain us. I think it's helpful to have that context as you're making your decisions, like, well, what's the long-term forecast? It's nothing alarming like terrible news, but it's not going to be as golden as it has been in the last couple of years, is what they're projecting. Of course,
Yeah.
The future is uncertain.
But overall, we're okay.
Overall, we're going to be okay, but I can say for sure this next budget year is going to be much more like muted, constrained than we've had the last couple of years, where we had really we were kind of catching up
Right.
from having a really low year during COVID. And then we did a lot of catching up in the last couple of years' budgets. And this one's going to be like more constrained. And they're projecting that it's going to be constrained for a couple of years.
Okay. Yes, please go ahead with questions.
Couple questions. Is attachment C part of this report or right now? The effective evaluation forecast?
This is the attachment for this report. It's the Beacon economics. And then the other attachments are for the next item. I mean, they're all related because they're all kind of talking about what's going on in the economy.
Question regarding Beacon, kind of like our, they've been with us since 2009.
Yeah.
Do we do RFPs every 5 years, like we do with the auditor?
We have not. The cost of the projection they do for us is fairly minimal. However, we did at one point do a side-by-side. We contracted with another firm called HDL. We did that maybe 5 years ago, and we looked at what their projection was. And HDL is like a very micro analysis where they looked at every city and the assessed value changes that they were seeing in every city. And we compared how their projection did to Beacon's. And interestingly, Beacon's was actually more accurate. So Beacon is a very macro looking firm. As you can see from like their report, it's giving you lots of high level, but it seems to be actually decent at projecting where we're going to be in the future. Whereas HDL, they got so into the micro, maybe lost sight of the big picture.
Well, it might be a good idea. Yeah.
Yeah, no, I think that's a great thought.
Sure. It would be interesting to see what's the position with the CPI.
Ooh.
That would be an interesting chart.
That would be. Okay, that's a good idea. Okay. Yeah. Okay. I'll try to get that included for next year or some future finance committee presentation, see if we can put something together.
Great. Thank
Okay.
you.
That was going to be my question as well. I like your idea better than what mine was going to be. Mine was just going to be a question. How does the increase, the percentage increase in property tax year over year currently for the projection for the next year, does it beat inflation?
Yes. And I think there's like inflation macro, and then there's like inflation at the.
He said Bay Area CPIs, which
It's a good one. Yeah.
what I want to, that's what I'm most concerned about because that's a basis for a lot of things.
It certainly has in the past. And whether it will in the future is like be a great thing for us to map and get like some CPI projections and see where that's supposed to head. Yeah.
It'd be, yeah, maybe go back a few years. Yeah.
Yeah, it definitely has exceeded it in the past. So that's where we've been really fortunate.
Yeah.
Yeah.
The kind of
great-
place we
great
live in
idea.
here. It's just the nature of development and that sort of thing. So it sure helps us as long as we're doing our end of the deal to do the preservation. It can support the densification in other places, I guess. That's the way I look at it. All right, thanks. That's
Good.
good.
Any questions on this item? Thank you very much. Anything else you'd like to add? All right, thank you. And then our next item is the, are there any public comments on this matter? All right, thank you very much. The next item is under action items, item 5. And it's the June 30th, 2023 investment report and portfolio report.
All right. Deborah Spalding, Assistant Finance Officer. And this is your second quarter investment report. And I'm going to start off by walking you through one of the attachments to this report and just kind of taking it like piece by piece. And then I'm going to turn it over to Monique Spike, who's here from PFM, and she's going to get into the detail of, what are the economic projections for the U.S.? What kinds of changes does she see happening in the future? So looking at that chart, and I'm sorry we don't have page numbers, but it's, well, if you can look at it on this slide, maybe more easily because it is very small writing in the chart. So the first piece is just up at the top where we're looking at the cash balances. And so how much we have either in cash or easily convertible to cash. And we're comparing how we are as of June 30th to how we were the prior quarter and how we were a year ago. And as you can see, and when you compare us to the last quarter, the end of March 30th, a big increase in our liquidity portfolio. And that's because we receive one of our 2 major property tax payments. We receive it in April. We don't get the next one until December. And so we're kind of living off of that, that big influx for the next 7 months or so. So that's the main takeaway on that slide. Going a little bit further down on that page, looking at our short and midterm invested securities. So there's not a big, if you compare where we were at March 30th to where we are June 30th, not a huge, there's really minimal changes. But actually what's happening behind the scenes, and Monique will speak more about this, PFM is either allowing investments to mature and purchasing new securities that are higher yielding. And so going forward, we'll have some higher interest earnings on the portfolio. So it's hard to see that here, but over the long term, we should start to see some benefit of the rising interest rates. And then lastly, down at the bottom of the page, we show our project bond funds and then also our debt service fund balances. So not a lot happened in the project bond funds. We need to do a drawdown from the trustee in order to see any changes happening there. But if you look down at the debt service funds, you can see a big increase. Again, that's our property tax payment coming in. And when we get those payments, we also get the money for our debt service. And so you can now see that in our Measure WW debt service fund, and it's getting ready for the September 1st payment that's due. Yes.
Regarding the promissory note, is that the loan for Proto Oaks North?
Yeah. So back in 2012, we issued those promissory notes, and I think they were issued for multiple district facilities, but the main one was for the public safety headquarters. And as you know, that's been a long saga. But it was intended to be used not just for that, but for other facilities as well. And there were some other projects that were done.
Okay. And are there any, is that 5 million, is that projected to be used? Are there any projects that they're slated to be used on?
Yes, so that the majority of that money is already in a project. So it's been appropriated for Peralta Oaks
Okay.
North and just waiting for, it's starting to be spent down.
Great, thank you.
Any other questions or comments? Anything else you'd like to add? All right. Thank you
Right, so
very
I'm going
much.
to turn it over to Monique here. And
Any
she
other
has her own
comments from-
presentation, which hopefully I can share.
Any community comments? Welcome.
Try to get this in full screen mode. How do you do that? How do you do
I just clicked on that.
Yeah, I'll show you later.
All right.
It's nice to see you in person.
It is a pleasure to be here in person. Fun fact, I actually live in Oakland, 10 minutes away.
Oh,
So,
great.
I'm a big user of the park services, so it's always a pleasure to be here and see the great work you do in person. So good morning, everyone. As is typical, I plan to take a few minutes to talk about the economy at large and what opportunities that it has presented and challenges that has presented in the investment environment for the district. So I'll start off with just a couple of headline thoughts on the economy, and I'll speak through these so you don't necessarily have to read in detail. But as has been the case past few quarters, the U.S. economy is really focused on the headline inflation number. The Federal Open Market Committee, the Fed for short, has been really enacting a program of raising interest rates in an effort to combat the pace of inflation. Now, the good news is that inflation numbers themselves are trending lower, but the Fed has started to focus on a couple of inflationary measures that are not as typical. One being super core inflation, which is an inflation metric that removes the impact of pricing on food, the impact of pricing on gas and energy, and the impact on pricing on housing. The thought process behind this focus on supercore inflation is that food and energy are very volatile measures. Supply and demand have a lot to do with the pricing of those things. And housing, interestingly enough, is a bit of a trailing metric. Housing prices change on a lagging basis. And so they felt by removing those components, they'd have a truer sense of what inflation in the economy is doing. And although the headline number is slowing significantly, they found that the supercore number, excluding those components, is actually still fairly high. Now, what has that done? That focus has essentially convinced market participants and has given cover for the Fed to perhaps continue their trend of increasing interest rates a little bit further than we had previously thought. So by the end of the second quarter, they had taken a temporary pause, but had announced that you may see some more increases to round out the year. Since then, in July, the Fed actually did increase the overnight funds rate by 1/4 percentage point. And there was some talk that perhaps we'd see another rate hike this month in September. We've actually pulled back a little bit from that. I think the odds are that we may see rate hike at about 33%, perhaps by year end. Other things that are going on in the market is that the labor market continues to be exceptionally strong. And what I mean by that is it was anticipated that with the Fed increasing rates at this pace, you'd see lower investment in business. You'd see folks not expanding, and you would see a bigger impact on the jobs market. Now, that has just not proven to be the case. Both wages continue to rise. Employers are still having trouble finding employees to fill positions. You walk down any main street, there's help wanted signs everywhere. So there still is a job available for most who are looking. The current unemployment rate stands at 3.8%, which is a tick up since the end of the quarter. And that increase in unemployment is actually because more people are re-entering the labor force. So we actually saw an increase in the labor force participation rate. So again, the jobs market has continued to be a fairly strong point in the economy at large. Now, with that, we've seen sentiment trend more positive, both among the consumers and among investors. And so consumers have continued to be resilient. Now, I already talked about the Fed's expectation with regard to rate hikes. Again, we saw one in July. We may see another one yet this year. But I think what's really important is that during the second quarter of the year, the investor sentiment around rate hikes really solidified, meaning that you saw investors finally believe that the Fed was going to continue to raise rates and more so keep those rates higher for longer. If you recall, a couple of quarters ago, we were talking about the idea that perhaps the Fed would start lowering rates at the end of this year. Well, that idea is completely off the table now. Folks anticipate that rates will stay at these levels, current levels, or perhaps even a bit higher through the fall of 2024. So we're anticipating rates to stay at these levels. Now that presents a great buying opportunity for us, for your portfolio. We've been able to purchase investments at decade highs in the longer term portfolio. And for the district's cash, that Spalding spoke about, you're actually getting a very great rate of return on those assets as well. So a couple of things to round out this slide. There was some volatility in the markets during the second calendar quarter. A lot of that had to do with concerns about the U.S. Debt ceiling and whether the Treasury was going to default on debt. Ultimately, that issue was resolved where the executive branch and the legislative branch came to an agreement on that debt ceiling issue, and we saw bond yields come back in line. Other thing that still persists is that the yield curve is still inverted. And when I say inverted, I mean that shorter term bonds are providing higher yields than longer term bonds. The reason for that is that the Fed continues to raise the Fed funds target rate, which is an anchor point on the yield curve. However, the outlook for growth, which guides the longer end of the yield curve, is still relatively low. And so that's why you have high rates over here and lower rates over there. So let's briefly speak about inflation, because I want you all to see a visual of what I meant when I spoke about super core inflation. So first things first, this is a chart of the Fed's preferred inflation metrics, which is PCE, or personal consumption expenditure. PCE is different from the headline inflation number you hear about on the news, which is CPI. And the big differences between PCE and CPI is personal consumption expenditure also includes the cost of things that are paid for on our behalf. I love to use medical insurance premiums as an example of this. As we all know, for those of us who are employers, have employees, the employers are often paying some portion of that cost in addition to the employee. So PCE takes into account those things. Now, I spoke about the Fed looking at super core inflation rather than the metric that's closer to headline. And on this chart, PCE, which is closest to the headline number, is in the darker blue. And so you can see that dramatic trend downward in that metric since the start of last year. And so policy is working, inflation is coming down. But when you strip out food and energy, core PCE, which is in the yellow, you can see that that trend isn't necessarily a sharp decline. And super core PCE, which takes out food, energy, and housing, is also fairly flat. So this is the metric that the Fed is looking at to say, well, you know, things seem to be working, but there's something that's not quite getting the memo in the market. So perhaps we do have to keep track with our current policy, raise rates a little bit more. And that's where we all got the idea that the Fed would see more rate hikes this year. Question, Director Rosario?
In the blue bullet there, can you define labor intensive services?
So labor intensive services would be things construction, anything that's sort of manual labor that takes a lot of parties to enact. Production style services.
So like blue collar jobs versus
Yes.
white collar? Okay, great. Thank you.
So let's talk about the yield curve. We already talked about it being inverted, again, where the shorter end of the yield curve is providing higher income opportunities than the longer end. And this is representative on the chart, which tracks the US Treasury curve. I want to direct your attention to the bottom of this exhibit where it show the yield changes by maturity. Because I think what's really important is as the market got on board with the idea that rates were going to be higher for longer, we saw a drastic increase in investment yields quarter over quarter, so from March 31st to June 30th. The 2-year Treasury bond, for example, rose 87 basis points, almost a full percentage point during the quarter. That is exceptional movement for the bonds. As I said, that creates a buying opportunity in the portfolio, which is the rosy side of this coin. The not so great side of this coin is that when you have interest rates rise, you see market values decline. And so the way I like to think about that, just to put it in some context, for the committee is that essentially if I purchased a bond 2 years ago when rates were really low and that bond was paying me 50 basis points. And today I can get a similar maturity bond that's paying me 4%. Then I would like a discount to buy your bond that you would like to sell me that's paying 50 basis points. So when we talk about market value declines, that's what we're talking about. The value of the securities that are already in the portfolio have declined with this rate increase. Now, that is something that just happens naturally as a result of what's going on in the market. Our job as your investment advisor and portfolio manager is to mitigate that risk. The way we do that for the district is we look to diversify your portfolio with securities that are providing good income that will offset those market value changes quarter over quarter. We also look not to have you overly exposed to bonds which are too long. Longer term bonds fluctuate more than shorter term bonds. And so that's part of our duration management process when we're managing the maturity distribution in your portfolio. And all those things has worked really well together to provide the district with great rates of return and great overperformance versus your benchmark. So just to take a look at that market value change that I spoke about, this chart shows the 1 to 5 year indices. And I want you to think of the 1 to 5 year indices as just a basket of securities with maturities between 1 and 5 years. And so the US Treasury index, if you're looking at this exhibit on the left, is just the second quarter returns. So between March 31st or April 1st and June 30th. And the US Treasury, you can see a very sharp negative total return of negative 0.86%. Now, again, total returns take into account that market value change and any income that's earned. And there was not enough income in the Treasury basket of securities to offset that market value change. And that is because interest rates rose so much during the quarter. But as you go to the right and you can see other security types, this is what I mean by diversification. Those security types perhaps paid a little bit more income, had more positive interest to offset those market value changes. And so you had less negative performance from the federal agency basket and from the corporate basket. So your portfolio benefited from having those types of securities in addition to treasuries. And asset-backed securities include securities that are backed by credit card receivables, auto loans, equipment leases, and you see positive performance there because often you're getting more cash flow to offset that market value change. So a couple of things to round out the market presentation. I just really want to highlight the Fed's updated economic projections that they released in June. And the most notable is the top left, which is the change in real GDP. Now, GDP is gross domestic product. It is a reflection of the expected growth in the economy each year. And what I think is really notable about this is that in 3 months, the light blue, right here in the top left, the light blue was their projection for annual GDP in March. And in 3 months, that projection jumped significantly to positive growth of 1% for the year. And that's just a testament to, again, the resilient consumer, the fact that unemployment's still low, even if there is some stress and pressure on the consumer from, higher credit card rates or higher loan rates, there's this belief that folks will be able to get employment to help with that should they want it, just because of what's going on in the economy. So I think this is a real testament to the Fed's faith in the economy and economic activity to raise that rate so much. Any questions on the market before I dive briefly into the portfolio itself? Director Rosario?
Can you go back to that last slide? The uptick in, if I'm understanding the GDP right, it's basically gross national product, or gross domestic product means the products that we produce and export.
Yep.
And then any imports is taken off of that.
Yep.
So I find it really interesting because as the tensions with China have become more escalated, more and more, and the environment in China is changing because their unemployment rate is something like 20%, and a lot of companies are coming home or switching to different countries.
Yep.
So I think I see there's probably going to be. I think I see why the optimism on projections for a stronger economy are looking forward.
GDP also includes consumer spending and business spending as well. As government spending. So when you take into account all of those metrics, the consumer has been incredible. I keep using the term resilient, incredibly resilient. Seems like there's nothing that's going to push us from buying things. And that has really propped up the economy in some ways. Housing prices have remained fairly stable despite the higher interest rates. There are all these things that are really sort of holding the economy afoot, and that plays into this revised projection upward for GDP. Yeah,
it's a stark contrast because it's there between China and the United States and how we handled the pandemic. And they closed down their basically their economy.
Yes,
and
they've been having trouble coming back from that.
They're not coming back. They've left or shut down, and the fact that the government didn't give their folks the money to prop up the economy like we did. It's really amazing. It's pretty a stark contrast, and it's pretty interesting. It's going to play out in the future there.
Yeah, it'll be interesting to see how that plays out. And, you can see, pockets of, COVID policy and residual COVID policy, even here in the Bay Area.
Yeah.
Downtown San Francisco is still having trouble getting back to what it was before the pandemic. And other city centers across the country have had an easier time getting back to, foot traffic and.
Yeah. And then I wanted to talk about the inversion. Typically, if you think if the inversion curve was much steeper, if there was a greater separation between the short term and the long term, usually that portends a recession.
Yep.
And so with this, we're seeing maybe like a slight downturn.
I chuckle a little bit because I feel like we're all waiting for the recession. I feel like, we've been waiting for it. At this point, if you think about it, the Fed's been in this aggressive rate hike stance for, more than a year at this point. And, there's been talk about, will we see a hard landing? And then it was like, well, I think it's going to be a soft landing. And now I almost feel like we're in it. Like, this is it. The Fed's at the end of the cycle. Interest rates are high. Folks have been living with these rates for a long time. We're still waiting for that recession to appear. And with this revision upward in GDP numbers, it seems as though the Fed has given up on that idea. Actually, I think they're not even showing negative growth for the foreseeable future in this projection. So, a lot of economists will talk about, waiting for the shoe to drop, whether it's going to be, the housing market will ultimately collapse. When will credit card receivables catch up? Are folks lagging in payments there? I think folks are looking for the bad news, but the numbers just haven't supported the impending doom as much as sort of sentiment has. So we continue to look.
Thank you for your take on that.
Any other questions on the market?
I don't have any additional questions. How about you?
All right, so let's talk briefly about the portfolio. The portfolio is in compliance with the district's investment policy. We maintain compliance checks daily, as well as prior to any trades and post-trade. The portfolio, and this is just, again, the core portfolio of securities. It excludes the cash that Ms. Spalding spoke about earlier. We have about $144.4 million in the portfolio. And the portfolio is a very high quality with an average portfolio credit rating in the AA category. And that does include your treasury obligations, which are rated in the AA category by S&P and also now by Fitch. You can see in the upper right, the donut, the portfolio is well diversified by sector. So our goal is to really utilize the sectors that are allowed by the district's policy. We are a relative value manager, so we're constantly looking for opportunities to add value over and above the treasury sector when we can. And when we feel there is not value, then we utilize treasury securities in the portfolio. The portfolio's duration distribution on the bottom right versus the benchmark of the portfolio, which is the 1 to 5 US Treasury Index, is shown. And just a couple of things. We were a little bit short. You'll see that we have a little bit more securities in the 0 to 1 year area. The portfolio is the dark blue and the benchmark is the gray, than in the 4 to 5 year area. This has been purposeful. We've allowed the portfolio to drift a little bit shorter as rates were rising over the last few months. This has allowed us to protect some of that market value that I spoke about earlier, and also gave us greater flexibility to take advantage of rising interest rates. So we've been able to buy higher yielding securities as rates have risen. As we are essentially at the end of the Fed's height cycle, we will be moving some of those shorter term bonds out across the yield curve because rates are at decade highs. For example, the 10-year average of the 2-year Treasury security is a 1.38%, and the 2-year ended the quarter at 4.90%. So that just gives you a sense of how attractive long-term rates are right now. Oops, go back. This shows the portfolio activity through the quarter. If you look at the blue bars, it shows you where we made purchases, and the gray shows you what was either sold or matured out of the portfolio. So we were net overall buyers of asset-backed securities this quarter. One of the reasons for that is they provided great cash flow characteristics. As you saw when we looked at the total return chart, asset-backed securities was one of the only sector that had positive returns in the market. Agency commercial mortgage obligations as well were a big hit this quarter. And those are commercial mortgages, which essentially are multifamily housing, et cetera. In terms of total return performance, as I said before a couple of times, we did see negative total returns for the portfolio, but we're really happy with the performance. A couple of things to point out. The 3-month earnings in the portfolio were $835,333, and that is just for the quarter. If that keeps pace, then we'll see earnings for the year basically average out to about 3.2 million after 4 quarters of earnings at this level. So it just goes to show that we're really moving the needle on interest income as we're able to buy higher yielding securities. Now, we did see a big change in market value, that negative 1.3 million. That's transitory in nature. We don't expect that to last very long. Again, as the Fed finishes their cycle, we'll see that calm down a bit. But on a net performance basis, we are up versus your benchmark by 47 basis points. So we outperformed by 47 basis points on a net basis. So we're really proud of that performance in that we were able to protect more of your market value while picking up higher yielding securities. So we're really happy.
Nice news.
When you take market value shifts out of it, the earnings for the quarter were positive. You can see that positive 526,000 in the portfolio. And then I'll briefly speak about the ESG policy. As a reminder, the district has an investment policy that looks at environmental, social, and governance risk management for the issuers in the portfolio. We have a team of professionals who work on this portion of the portfolio, and our goal is to ensure that the issuers in the portfolio are managing environmental, social, and governance risk appropriately. Just a high-level overview. These slides are slightly different than what you have seen before. We show in the pie chart essentially where the risk in the portfolio is. Now, ESG risk is comprised of a quantitative score. Essentially, our partner, Sustainalytics, evaluates each issuer, what environmental risks they're exposed to, what social risks they're exposed to, and then evaluates how they are handling that risk. Are they being responsible stewards for environment, perhaps, for example? Are they being responsible managers in the social category? And then they assign a risk. Now, the lower the risk, the better. The goal is to have a portfolio of issuers who are paying attention to these factors and managing them appropriately. About 51% of the portfolio has issuers that have an ESG rating. It's about 65 of the 73 issuers. And just based on that percentage, you can tell like US Treasury, for example, wouldn't have an ESG risk score. So the portfolio's average risk rating is 21.6, which puts it in the medium category, but on the low end of that medium category. So we're doing pretty well. This is a slight uptick, almost negligible from the last quarter, which was 21.4. So we're still in range. You can see where the sectors who have the highest ESG risk are in the portfolio. And unsurprisingly, that's the corporate sector. Corporate issuers have a little bit more going on, but you can see that supranational issuers, which are your, World Bank, for example, have very low ESG risk. Asset-backed securities, 20.9. And then also federal agencies are right there in the middle. We added this exhibit, which is relatively new, which breaks out the ESG scores by rating category. And you can see in this exhibit, that gives you an ESG key. So just to remind us where the numbers correspond to the ESG risk rating. We show the credit ratings, how much is actually in the portfolio by those rating types and where the ESG risk is for those issuers. And then the average ESG risk by rating category. Now, again, these are S&P ratings, which is why you'll see a triple B in there. But it essentially shows you where the ESG risk profile goes. And unsurprisingly, as you sort of get into the lower rated categories, the ESG risk rating rises. And that is all I'll have for my formal presentation. I'll hold for any additional questions.
All right. Thank you very much. Any questions? Colleagues? Please go ahead.
I thank you for presenting that in a way that, well, I'll speak for myself. That's very understandable. And actually, it occurred to me that I was listening to a Bay Area economics market sort of blog.
Oh, great.
That's what you did, in my opinion. So, and I kind of like those sort of things a lot. They help us to understand. So thank you for presenting it in a way that's just technical enough, but you're not showing off that you know more than we do. It's like you're just, it's very good. It was good tone, good message.
Thank you.
And I think our folks are, to the extent that they're providing guidance and that sort of thing. I should point over here. No offense. That, things are that we're taking advantage of things that we can take advantage of. So,
Absolutely.
yeah.
Thank you, Director Mercurio.
Yeah. Thank you.
Thank you. I agree with everything he just said. Thank you.
Thank you.
Do you have a comment?
Just want to say that I think you and your company are doing well, and your the fact that we're in a positive mode speaks well to that. And carry on. Thank you so much.
Thank you.
All right. Thank you too. Thank you. Support you in the work that you do, and thank you for that. And even where you can see there's a few things sort of wiggling around in there, we're doing okay.
Yes.
And you're keeping track of that and making sure we're doing the right thing. So thank you very much.
Absolutely. Thank you.
Any other items anybody wants to comment? Any public comments on? Okay. All right. Well, that was the investment report and portfolio report. And the next item is number 6. If there's any announcements. Oh, you're right. It is an action item. So who would like to make a motion?
So move.
Okay. All right. Please go ahead and call the roll.
Recording Secretary Shannon Rice calling roll. Roll call vote. Chair Corbett,
Aye.
Director Mercurio,
Aye.
Director Rosario.
Hi.
Thank you.
Thank you very much. It passes unanimously. Thank you very much. And the next item is number 6. Any announcements anybody would like to make? Yes. Do you have
No. Comment.
okay. A comment is fine too. The question is good too. What would you like? All yours.
Since we're in the finance committee, in going over the board packet and the check listing, I had noticed that we had quite a few late fees, and I was wondering, and I got an answer that there was some vacancy issues, and I'm wondering, do we have something in place that will so that we can prevent these late charges? Is it? I mean, is the labor shortage, is it that acute?
So the labor shortage began at the end of last year. So end of 2022, we had our supervisor retire, another AP staff member go on maternity leave, and then one of our AP staff members got promoted into the supervisor position. And the impact of that has been sort of like a very slow decline in the number of invoices that are being processed each week, as we were like trying to backfill those vacancies. So you're now starting to see the late fees that have, as we're like, once we pay the invoices, then you see the late fees. So you're starting to see it now, but really the problem happened months ago. You're just seeing it show up in your packet now.
Yeah.
So we're past the worst of it. We're not back. So we strive to have 80% of invoices paid within 30 days. That's our goal. We're not there yet. I'm hoping by the end of the month, we'll be back to that. We have 2 temporary staff who have been helping us get caught up. So we've overstaffed in the last couple months to get us back on track. But there was a period where we were behind that we're still catching up on.
So how do we when you have someone going on maternity leave, I mean, that's something that's foreseeable. So is there is there a plan in place for, to, how do we backfill those positions? Do we post it as acting, or do we go to a temporary service?
Yeah, so we always have to post it for acting per the MOU. And if we don't get someone, then we can go to a temporary service. I think we learned a lot from this experience, and that
Good.
we maybe were a little too, complacent about like, this will be fine, we'll make it through. And then it became clear like, oh no, all hands on deck.
Yeah.
But we figured it out a bit too late.
Okay. So hopefully this won't happen in the future.
I do not think it will happen in the future.
Okay, good. Thank you.
Yeah.
That was just my concern. If there was an acute shortage, in if we don't have enough accountants to put out our invoices, then we should know about it.
Yeah.
And we should hire accordingly. So
Yeah.
thank you. Keep our eyes open.
I do have some questions too with regard to our next meetings through the rest of the year. Could you just fill us in on that? Because I know there were a few months we skipped over because of other work that was being done in-house. So, and dates moved. So if you could just give us a clue as to when the meetings will be.
Yes. So I have suggested that we should cancel the October meeting. And I'm not sure if that has made its way up to the Finance Committee, but that was a suggestion due to the items that were scheduled not needing to go forward in October. They could get pushed to November. And then I believe also that there were some scheduling issues for one or a couple of the Finance Committee members wanting to go to attend a conference that would have conflicted with that date. So that was my suggestion. I don't know that it's been officially sent up to you guys, but. And then our November meeting is, I believe it's on the 20th. It's always the Monday before Thanksgiving.
Yeah.
And so that would be our next meeting if we were to cancel the October meeting.
Okay. So are you saying the meeting would be canceled in October because of this other meeting coming up? Because we definitely don't have to go to that other meeting.
It would be canceled just, we have two items that are moving forward.
I
But they
think-
could go to November easily, and that would actually be better. We're a bit short-staffed right now, so that would be easier for staff.
Okay, be
so
better for,
it's-
because I don't know. I don't think anybody insists upon canceling the meetings just so we can go to another meeting.
Right.
It's what's best for
I'm
you.
asking what the date is because I think I'm one of the ones going to that committee,
Oh, okay.
that conference. Is it around October 12th, around there?
October 25th.
October 25th.
But it would work okay for us
Would
to
be-
miss the October meeting as
it
far
would
as getting the
be-
work done that has
it
to be
would
done
be
before the end of the year.
Be easier for me if we didn't have the October meeting and we just moved those items to November.
Okay.
November, we'll be looking at beginning of the budget for 2024.
Yep, that's our budget meeting.
Okay.
Okay. So what would the dates in November? The
That's a
date?
heavy packet.
Yes. Well, that's something we have to think about too,
Yeah, so
because of the time of day too. So. And it would be okay to do the November meeting in the hours it needs.
So November 20th at 11 a.m. is what we previously had
Yeah, okay.
scheduled. Does that work?
Yeah, we should
Okay.
stick with that.
Good.
11 a.m.
11 a.m. Yes.
Okay.
Oh, I have one other question.
Wait, I'm not quite done. So,
When you're done.
is that it for November? The idea is to have a November 11th meeting, starts at 11 a.m.
November 20th.
Excuse me, November 20th
Yes.
and goes till 11 a.m. It starts at 11 a.m. and goes a couple hours, 3 hours maybe.
It'll probably be a couple hours because it's the budget meeting.
Okay. So to one.
Yes.
Okay. And then there'd be a December meeting?
And then there would be no December meeting.
No December meeting. So just one more meeting.
That's the plan.
Okay.
Oh, Don't we have 2 meetings in December? Don't want
So you have two board members, two board meetings in December, but typically no finance committee
Okay, right,
meeting. Yep.
because we're presenting the budget at the
Yep.
board meeting.
Yeah, so there's
Got
a
it.
first reading and then the second meeting, the adoption. Yeah.
Streamlined.
Yeah.
So one more meeting in
Forgot.
November.
Yeah.
Yeah.
In December. No meeting in December.
We should be getting these calendar invites because I have them.
I don't.
Don't you send out calendar invites on these things? Yeah, that's why it's on my calendar. Yeah, but the other one hasn't been canceled yet. I can see that here.
I know,
So,
but I'm just double checking because I know
Yeah.
there's been some changes and
Yeah.
thoughts and all that. So I just wanted to get the latest. Okay,
Thank
all
you.
right. And okay, all right. Dee,
And I just have one general question. We just went through our auditing process and this is because I went to the finance breakout in the CSDA. And so the external audits that we have, they're kind of limited. They don't look at they don't look for let's say vulnerabilities in the structure of the district itself. But
Director
they look at
Rosario, this is not a topic that's agendized for this committee, and we're now under announcements.
okay.
And so I've given a lot of latitude, but we're really starting to digress into having discussions on non-agendized items. So I really want to
Okay. Can I
respectfully
ask
ask
you a
you.
question to provide for the
It
next?
would be better for you and Deborah Spalding
Okay.
to have a conversation after the meeting, and then you're in compliance.
Okay,
Thank
thank
you.
you. That's why you're here. I will ask you after. Okay, thank you.
Thank you. Deborah, do you have any questions for us?
No, not.
Okay, very good. But it sounds like moving October works well for the work that you're doing. So happy to do that. Thank you. Any other comments, questions under this subject matter? All right. With anybody want to say anything about what's going on in their work? Or we can just adjourn, whatever's best.
It's really time for adjournment at this point.
So we're ready. No announcements. Anyone else? Okay. Okay, this meeting is adjourned. Thank you all very much.